Hi, everyone. Welcome to Peterson Wealth Services Point of View. I'm Shaun Peterson, also have Billy Peterson on the video today. And we wanted to give you a quick little fall market update. And I'm just going to kick it off. I'm going to toss it over to you, Billy, since topic of the day lately has been interest rates. Let's dive right into it.
Interest rates are so critical right now. As everyone knows, we've seen rates go up at an unprecedented level since last year. We started to try to deal with inflation and all the problems surrounding inflation. So we just wanted to talk about why the markets are volatile, and that's largely due to the rates. You see here on this chart, going back about 15 years, and we're talking about the 10-year Treasury versus the 2-year. And you can see that we have now inverted, which actually occurred last year. But you have the 2-year yield at 4.93 versus the 10-year yield at 4.67. Typically, when you see an inversion like that, the markets are pricing in a recession. The recession, everyone's predicted it, but it hasn't yet happened. So currently, we're forecasting a mild recession, nothing major, but it's a recession nonetheless. It's just a slowdown in the economic growth. We plan that to happen probably sometime this next year, early in the year. This means that people need to be watching the consumer, and also we wanted to talk about what this has done to short-term investments. This spike in the short-term yields has led to very high levels on money market funds and CDs, and some people are kind of getting swept up in that. They're looking to put a lot of their money in these short-term investments. We think it's fine for short-term money. So if you have savings accounts or things that you need in the short term, great. But don't get fooled into thinking that long-term money belongs in these short-term investments. Even if you can get 5.25 on a money market, those rates are going to slowly bleed away, and you're going to be back to 1-2% money markets within the next several years. And same thing with CDs. You're going to just have reinvestment risk. It's going to take you lower and lower and lower. In the meantime, you're probably going to miss out on the upside of the equity markets. So let's go and talk about that.
Yeah, you can miss some upside in the equity markets, because I know everyone's frustrated right now with the stock market, which, it's funny. Over the last couple months, we've went into what we call a correction territory. So from previous highs, the market has dropped 10+%. And investors forget that that is completely normal in the equity markets. You should almost expect that, but it makes you think, well, what am I doing this for? Maybe I'll just put everything in a money market. And like Billy said, that long-term could be a very costly mistake. And I'll show you a chart on that later. But let's talk about what's gone on with the stock, and more importantly, I think the bond market over the last couple years. Bonds last year were down about 15%. Okay, bonds are supposed to be our safe investment. We've been saying this day is coming for the last 2 or 3 years, if you want to go back and look at some of our other videos, but it's simple math. If you see interest rates go up, you see bond values gone down. And we have seen interest rates go up faster than we've ever seen in history. So we've paid the price on bonds. This year, bonds are still down 1%. Okay, so they're acting like a anchor on our portfolios, and it's important to remain diversified. But again, this has been a very weird environment. Stocks last year, measured by the S&P, were down 20% or so. This year, stocks are up, and by stocks I mean the S&P 500, about 15%. However, need to take a very much closer look at that. The returns have come from what they're starting to dub the Magnificent Seven. It's these 7 tech names. You take those out of the S&P 500, and you're looking at flat to negative returns in the S&P 500. Those names over the last 2-3 months have sold off. Why? Because, hey, the market's repricing in that the Fed is going to continue to potentially hike interest rates, which are not good, which isn't good for companies, because a lot of them are borrowing money to create their products, to build their buildings, to expand what they're doing, and it's coming at a higher cost of capital, which could eat into earnings. So market's repricing all that. Remember, the market is looking forward. It's not looking backward. This is another great chart, I think, just showing you the value of staying invested over time. So it takes a person that had $100,000 invested, see some decent returns, and then this gray bar chart here is a quote unquote market crash. It's actually the real estate recession that we saw in 08, 09. And then people get to a decision point. What do I want to do? Well, one person just bought and held through all that. And you can see their ending value, $747,000. One
Now,
person
this
said,
makes sure we want to point out that it's not buying at the end of the correction. It's buying well
no,
before the correction
you bought
occurred.
way before and went through the correction, and you just stayed put, is what that's representing. The other person moved to cash for a year, or a quote unquote a money market for a year. Their ending value is $454,000. The other person said, you know what? I'm not going through another crash again. I'm going to move to cash. And their value ends up $139,000.
Yeah.
Huge, costly mistake.
Shaun's using a term there that the media likes to use, which is crash.
Yeah, I'm just reading it from the chart.
we don't really use those terms here because it's basically just saying, riling up people. Remember, the media is not your friend in almost any segment of your life. So don't get caught up into listening too much to the media. Let's talk about the consumer now that we are moving into who holds up this economy. And 70% of our economy is basically the consumer spending. And we have seen consumer spending really being upheld by a feeling of security. Net worth is at an all-time high. Our consumer net worth, household net worth, has gone up by $95 trillion since the last peak. And that was before the recession that Shaun mentioned a few minutes ago. So the last peak, we had a $71 trillion net worth. And now we're sitting at $154 trillion in household net worth here in the US. That's amazing, a huge increase. Some of this was driven by market gains here in the equity markets, and the other part of it was market gains in real estate. And real estate still sitting on pretty high valuations considering where interest rates are. Our feelings are that needs to moderate a little bit too, and that time will tell if that actually occurs. But we want to make sure that we point out why consumers feel so strong and feel so safe in spending.
They feel rich.
They do. They feel very, very rich. Let's talk about where that spending has come from. Obviously, people have income, they have a job, they make money, and then they have a certain amount of that money that's disposable income they have to spend after they pay for all their necessities. There's a certain amount left over. What do they do with that? Well, some of it they save. Historically, people save about 6.3% of that discretionary income, or disposable income. Then we see here this major spike here in 2020, and you could probably figure out what that was caused from. The pandemic lockdowns. The government shut us all down. We couldn't do anything. We couldn't go anywhere. We couldn't travel or go to restaurants or do anything pretty much. So of course, savings rates jumped significantly from where they were on the average, up to 32%. So that kind of created this pent up demand, and we got through that. They finally opened us back up again, and then you had what we call revenge spending, where people just said, I'm spending, I'm gonna, all this money I have piled up, I'm gonna do something with it. And that brought us down to well below historical averages. And so our current savings rate is only 3.4% of that disposable income.
I think a lot of that maybe coming down so quickly, like you said, the pent up spending that people wanted to do, but also, I mean, just the inflationary environment. We're not able to save as much as our income as we were before. And the one thing I think I would like to point out on the savings rate spike is, remember, we printed and handed out a lot of money during that time period, which created inflation. I'm just going to say it. I mean, that was poor policy that created this environment that we're in, and now we're trying like hell to get out of it. But this, I think what Billy's saying is, look, our net worth is really high, but our savings rate's starting to slow down. Maybe home values start to consolidate a little bit. Maybe that consumer starts to feel not as safe, right? We're kind of tiptoeing into that with how much it costs to live, and that is going to slow down the economy, which is actually what we're wanting to see, right, Bill?
Yep, that's what we need to see. We need to see that bad news on the economic data that turns into good news for market outlook, because markets price in what's coming, not what already happened. And so bad news in the economic world is going to create a good setup for markets to actually go higher because they're going to signal that the Fed is done raising rates.
Right.
So we're looking for that. We're watching it. We know what we're looking for, guys, and we've positioned our portfolios to try to take advantage of where we're at. We've changed some of the allocations, and let's just kind of wrap up what we've talked about here today, starting with the inflation readings.
Yeah, we're trying to keep a really good pulse on that. We need to see inflation come down. That's going to give the Fed some leeway to stop raising interest rates, potentially pause, and then go into this rate cutting environment, which everyone wants to see. Once you see that, the market, or once the market gets the feel that that's going to happen, and they're going to get the market's going to get the feel of that after we get some recessionary data that we've went through a recession. Remember, a bell's not going to ring and say, hey, we're in the middle of a recession. It's backward looking data. But the market, the stock market, is so liquid and so forward looking, it prices in the potential of Fed rate cuts. Okay. And that means that's where the market takes off. So we're watching that very closely. We're saying, hey, expect some volatility. We are thinking the Fed is not done hiking. Okay. So if the market, just like it did the last couple months, needs to reprice that in again, that's normal. That's just part of market cycle. Remember, corrections are normal.
Take advantage of those. Yeah, we just wanted to say that these things don't last forever. So short term, you're going to get volatility. It's what you do during that volatile period that matters. So if you run away from it and you get scared and you're tuned into the news and it pushes you away, then you're doing yourself a disservice. If you look at it as an opportunity that all the other people, the sheep, have run over the cliff, you're standing there ready and waiting, then you're going to actually turn that into your advantage, going on offense. If you don't have cash to put to work, well, just stay in your portfolio. Don't be thinking you need to jump off and jump back into like a money market. We've talked about how that's dangerous for long-term investors. Yeah, it sounds great right now, but you have to remember there's a reason why these things are priced the way they are. They understand that the 10-year, you get less than a 2-year. And that's because they know that these rates are going to come back down. So call us if you have any questions. This is an important time in our history, an important time in the markets, and we're setting this up for a resurgent, another bull market. Be diligent, but know that we have everything that laid out for you here. We're coming to you with some information that we think is important. Stay tuned and call us if you need anything.
Thanks for tuning in.
Thanks, y'all.